There is no indication that the news and impact of the recession will get any better anytime soon. This is due to the recent increase in inflation and interest rates, as well as the dramatic decline in the stock market. A lot of people have had their livelihoods ruined due to the impact of recessions on the economy and people's means of livelihood. However, if you know what to look out for, surviving a recession doesn't have to be a scary experience. The first thing is to think about your personal goals when deciding what to do to rise above the hardships commonly associated with a recession. Do you want to make investments that are recession-proof so that you can make some money even while in a recession? Or do you want to optimize long-term gains? Or maybe you want to establish a stable revenue source? Well, in this video, we talk about two assets that can help you cover these financial goals, as well as equip you financially to brave the storm of the recession. Hello, and welcome back. While constructing a portfolio that uses each of these methods would be ideal, effectively implementing even one of them could have a substantial beneficial effect on the future of your finances. Assets like stocks can fall in value during a recession as consumers cut back on spending, jobs are lost, and businesses reduce investment. However, the market can have some strong points, or at the very least, less negative ones, that can withstand a slump. At the end of the day, recessions are difficult to forecast. Making sure your funds are in order can be helpful in any situation, in case something unfavorable occurs or in case you need to put your funds to work by investing in recession-proof assets. And this leads us to the question, which investments are the wisest to hold in a recession? The first on this list is commodities or large-cap stocks. The asset classes that frequently do the best during recessions, according to Ariel Acuna, who is the founder of LTG Capital, an investor advisor and wealth management company based in Newton, Massachusetts, are those assets from large, well-managed corporations that are highly valued. He had this to say: companies that produce goods that consumers continue to purchase, like diapers and energy, do pretty well because consumers will continue to use them. These stocks may come from several industries, such as food, healthcare, personal care items, and utilities. Robert R. Johnson, a chartered financial analyst and professor of finance at Creighton University, asserts that regardless of the state of the economy, people still need to eat, clean their teeth, visit the doctor, and heat their houses. That doesn't imply people won't alter their buying habits within a sector, though. For instance, if the economy is weaker, people might go from steak to hamburger, or from buying at Nordstrom to Walmart. If you're new to this channel, do check out and watch the other videos on this channel. Leave your thoughts at the end of this video in the comments section, and subscribe to never miss a video. Now, the second asset that will possibly blow up your finances and get them in check during and after the recession is gold. Yes, you heard that right. In the past, the price of gold has tended to rise during economic downturns. For instance, from 1976 to 1978, gold climbed 54%, while the S&P 500 plummeted 19%. 2011 saw a 19% decline in the S&P 500 and a 9.4% rise in gold prices. Although not always the case, this tendency is often valid, seeing as gold did decline during the recessions in the early 1980s and the late 1990s. As a result, gold can be a wise investment now that the economy is in turmoil. Companies and employees experience pressure during recessions when controversial assets like bonds and stocks are down. As a result, people tend to flee to the safety of gold, which accounts for its rise. Buying gold is a wager against the dollar. Additionally, during recessions, when confidence in the Federal Reserve is down, people tend to place their trust in non-fiat currencies that aren't supported by governments and central banks that are perceived to be failing. If you think a recession is coming, you might be tempted to change your investing approach or even walk away from the stock market. But doing so could result in substantial losses. Therefore, it's crucial to keep a long-term view. All market reversals are just transitory, since over its nearly 200-year existence, the market has consistently continued to reach new highs. investors should consider lower prices as chances to acquire assets at rates they might never again see, instead of feeling scared of engaging in a weak or sinking market brought on by a recession. Having a conversation with a knowledgeable financial expert, such as a professional finance planner, can assist you in developing a balanced, diversified investment plan that can withstand a downturn. Thank you for watching, and we'll see you in the next video.